All right, let's talk stocks. We've got CNBC contributor Don Luskin of Trend Macro, who was kind of short-circuited last night. He's back for more. We also have Peter Schiff of Europe Pacific Capital. Peter, Happy New Year. Great to see you. And CNBC's famed media and tech editor, Dennis Neal, as always. Gentlemen, we're talking, one of the news stories we're following is Barack Obama, $1 trillion deficit spending as far as the eye can see. That was his proclamation today. And I want to ask you what this means to you as sharpshooter investors and investment strategists. Don Luskin, you first. $1 trillion as far as the eye can see. What does this mean to people in the market?
Well, there are deficits and there are deficits. If the deficit is in order to cut taxes, to liberate the private sector, I'm all for it. I never met a tax cut I didn't like. If the deficits are so that we can expand the power of government and they can create subsidies for uneconomical green technologies and buy a bunch of cement and pave over the prairies to put people to work digging holes and filling them up again, that's a huge mistake. I'm not afraid of debt. I am afraid of larger government.
How would you characterize the backbone of this one? Which category would it come under?
Well, they seem to want to have it both ways, which is a lot better than we were looking at 3 or 4 weeks ago when it was basically all spending. At least now they're starting to talk about tax cuts. They're not the kind of tax cuts I like. They're not particularly incentive-oriented. They have more of a subsidy flavor, more of a welfare through the tax code flavor. But at least it's putting money in people's hands where individual people can make the choice of how to spend and invest that money, not a politician.
Peter Schiff, take a whack at it. Big story today, $1 trillion deficit as far as the eye can see.
Larry,
give me your take on this.
What I don't like about it is the spending. I don't like government spending. I don't care if we're in a recession. Government should be cutting back. We should not be increasing government spending. Government should be cutting its spending. If we can cut spending enough, then maybe we can cut taxes. But if we just cut taxes and the government keeps spending, the real cost of government isn't what it taxes, but what it spends. And if it doesn't take it from us honestly through taxes, it's going to do it dishonestly by creating inflation. That is exactly what they're doing, and we're going to pay for this, not in the future, but right now.
All right, fair enough. That was Milton Friedman's argument, by the way, years ago. The true tax burden is government spending as a share of GDP. I did some back-of-the-envelope calculations, Peter, using the Team Obama numbers, and we're looking at something like 30% of GDP, which would probably be the highest going all the way back to the 1940s.
But, Larry, what important component is, I think a lot of our GDP is fluff. A lot of it is created by government statisticians using hedonics. And remember, a lot of it is spending. A lot of it is consumption and borrowing. If you look at the real wealth-producing components of our GDP, if you look at manufacturing and mining and farming and the real stuff that we make, and then compare our deficits as a percentage of that, it's enormous.
All right, so you don't like any part of it. Dennis Neal, though, rounding this out, as the news has come out in recent weeks, as Team Obama has put their plan together, and now we're getting some numbers on the plan, and maybe a little better shape regarding this, the mix of spending and taxing. We've had an excellent stock market. The S&P 500 is up 24% since November 20th, which looks like the bottom.
In 31 trading days, the Dow's up 20%. The NASDAQ is up 25%. The VIX Fear Index is down over 50%. I realize all the bears out there saying this is just a bear trap, fine. But you know what? I'll take it, number one. Second, deficit, yes, $1 trillion, way too big. But even conservative economists, I believe even Martin Feldstein, the Reagan advisor, says, look, you got to do it right now. You got to hold on because we're in a different situation. Next thing. Interest rates that the government pays on that debt have never been lower. We ought to be issuing as many 30-year bonds at whatever that really low yield is as we can. We ought to go with a 100-year bond.
But the cost and price will come due. See, Laffer says when you run up deficits like this for some period of time, it merely means future tax rates are going to go sky high and damage the economy and the stock market. Are you worried about that?
I'm worried about it, but I feel like we got to dam the torpedoes and full speed ahead.
Why?
We have to do this.
No, we don't have to do it. If you climb up to the top of the Empire State Building, you don't have to jump off. You know, you can change your mind and do the right thing.
Don Luskin, we're all going to come back. Just real quick on the way out, Don. Can the stock market move through the $1 trillion deficit?
Oh, sure, it's doing it right now. Stocks are priced right now for a 10-year global Great Depression. That's not going to happen. The upside's unlimited.
All right, hang on, folks. We're coming right back. Peter Schiff, Don Luskin, Dennis Neal. I'm Kudlow. Coming right back. More on stocks. We're back. Don Luskin, Peter Schiff, Dennis Neal. Peter, go to you. It looks like a very big energy tax cut, including, of course, the drop in retail gasoline, along with a lot of new money creation by the Fed, could be creating a stock market bottom and sowing the seeds of a recovery in the economy. And I note, in this rally over the past, 6 weeks or so, it's all the cyclicals, the pro-recovery sectors, consumers, retailers, financials, materials, energy, tech, industrials, Peter. I mean, this is an optimistic, bullish scenario. What do you make of it?
Well, I don't know if it's pro-recovery or pro-inflation. You know, I think this tax cut for gas is going to turn into a tax hike. You know, I see these stocks. I mean, many of the mining stocks that I own, some of these stocks have tripled and quadrupled in the last 3 and 4 weeks. I mean, some of the rises have been spectacular. Most of the energy stocks I own are up at least 50% off their lows in the last couple of weeks. So these are pretty big moves. I don't know if they're going to be sustainable in the short run or if they're going to continue. But I don't think they're pricing in a big recovery. Now, I agree with some of the things that Don said. I don't think that there's going to be a global depression. I think a lot of stocks around the world have been beaten too low, and I think there's a lot of value there. But that said, I think what the government is doing is very detrimental for the U.S. stock market. I would not be broadly buying U.S. stocks.
Don Luskin, is a recovery brewing? Is that one of the messages of this rally, where clearly the cyclical sectors are leading the way? The defensive sectors, for example, consumer staples and utilities, have only done about a third as well as the cyclical sectors.
Well, Peter, I think, you know, Peter and I quite unusually here are finding convergence in our ideas. I think what we're seeing here at first is a value play. Stocks just simply got too cheap. Some of this stuff just got the stuffing cracked out of it, and those are recovering. But that is what you would call the mustard seed. That is the kind of activity that investors see happening in their own portfolios, or they get a little envy when they see it happening in other people's portfolios, and they start realizing, aha, things are stabilizing. It's okay now. It's time to take a little bit of risk again. And as soon as people are willing to take a little bit of risk again, that's what causes a recovery to happen. Because if there's really any single definition of recession that just always works, it's when everybody stops taking any risk at all. They won't put their money out there, they won't put their labor out there, they won't put their consumption dollars out there. They freeze up. They go internal. And when they start willing to come out, when value brings them back into the marketplace, that's when recovery starts.
Pretty soon, what they're going to discover is that the safest asset is actually the riskiest asset, and people are going to flee from cash. They're going to flee from dollars, and they're going to move into stuff, not because they want risk, but because they don't want
Peter,
risk, and they properly identify the risk.
On the dollar play, it looked like it was reversing, but now it's coming back, and it's the yen that's weakening, Peter. What does that tell you?
Well, look, the yen is still in a powerful uptrend, and the dollar is weakened somewhat against the euro. But look how strong the Aussie dollar has been over the last few days, and the Canadian dollar. So you're seeing the dollar in general weak. Look at that huge reversal today in gold. You know, gold was down 20 bucks this morning, and it finished up about $5. So they're buying the dips here. I think the dollar has topped out. It's probably going to keep falling. And, you know, the bond market, I mean, we keep talking about the Madoff Ponzi scheme. Peter, our whole Treasury market is one giant Ponzi scheme.
Well, let's not forget here that the idea of a dollar weakening here is not necessarily a bad thing. It's not necessarily because people are terrified that the dollar is just going to become worthless toilet paper. It's because that incredible headlong demand for just simply holding paper money in your fists, because that was the only thing that would last, that's evaporating. People are starting to feel confident again.
Why does the dollar have to get weaker if Europe will cut its rates, which it's going to have to do? That helps us not have to get that much weaker, right? And that could be good for exports.
Don Luskin, are you going to play it from the long side here?
Absolutely.
Peter Schiff, are you going to play stocks from the long or the short side?
We're buying stocks every day.
You are buying.
Despite your worries. That's really good to hear. See, what I want is a new kind of fear to drive this market, fear of being left out.
All right. Fear of being left out, but I got a couple of bulls here. Don Luskin, Peter Schiff, thank you. Dennis Neal, thank you. I'm Larry Kudlow. Hang with us.